Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Markets often behave as though they have already read the next week's headlines. In some cases, they do when prices mysteriously rise or fall well before actual events. Yes, this happens all the time. And so there is this theory that market anticipates what's going to happen. So is the current rally that's going on telegraphing a durable peace plan in the Middle East, boosted by US President Donald Trump's incoherent and very often contradictory posts on social media? Across the world, equities have surged. The Nasdaq in the US has recorded 14 consecutive days of rally to hit all-time highs. The Nifty has surged 9%, 10% from the close of March 30th. Mid and small cap stocks, the usual high beta expressions of optimism, have raced ahead even faster. Crude oil prices, as quoted on NYMEX US, briefly spiked above $117 a barrel on April 7th, but has crashed more than 15%, and then 12.8% on April 17th to as low as $82. At the heart of this optimism lies a single assumption that the reopening of the Strait of Hormuz marks the effective end of the crisis. Now, whether the Hormuz is open or closed, there are debates because Iran has closed it and Trump has closed it even further, but people are expecting that the crisis is going to end very soon. For import-dependent economies such as India, this is a big shift. Lower crude prices ease inflation, improve current account, and brighten corporate margins. It's no surprise that markets have responded with enthusiasm, even at the discussion or the talks that are going on in Islamabad. But the reality on the ground suggests something else. The notion that Hormuz is open belongs more to social media than to the shipping lanes. Reports of vessels turning back mid-journey, of warnings issued by the Iranian forces. Yesterday there was a story of US having seized an Iranian vessel, and of insurance costs that remain prohibitively high. All this suggests that this artery of global trade is functioning very poorly, if functioning at all. If a choke point requires permission to pass, it's not open. Not surprisingly, having announced just 2 days ago that the easing of Russian oil sanctions would not be renewed, the US reversed course and renewed it on April 17th. On the diplomatic front, the gap between the Iranian and American positions remain wider than the Persian Gulf. The much discussed negotiations, informally dubbed as Islamabad track, remain in the initial stages. There has been no forward movement on the central questions, which include Iran's uranium enrichment, nuclear weapons, sanctions relief, unfreezing of blocked funds, the role of regional proxies, Israel's attack on southern Lebanon, war reparations, and, not the least, control and pricing of the Hormuz Strait. America continues to claim that its navy has imposed a blockade on Hormuz. Iran claims that as long as the naval blockade remains, Hormuz remains under its control. On Friday, after Trump announced that Hormuz is open, Iran claimed that the passage through the strait requires coordination with the Islamic Revolutionary Guard Corps. Meanwhile, a few hours after Trump announced that Israel has been prohibited from bombing Lebanon, Israeli operations continued, targeting infrastructure linked to Hezbollah. This looks more like a pause than peace. If markets are indeed forward-looking once again, it appears that all these issues will dissolve very soon. That's the bet. That's what everybody is expecting and acting upon. Talks are set to resume soon, but being forward-looking is not always prudent. In being prescient, markets can also be prone to wishful thinking. Investors have seized upon the most market-friendly interpretation of the events. A ceasefire will hold, talks will progress, and oil prices will remain low or contained. But the US benchmark has been divorced from reality. Actual transactions, I'm talking about the oil prices. Actual transactions have little to do with speculative oil futures contracts traded in New York. As Saudi Arabia's finance minister Mohammed Al Jadaan said, "You see $90 on the screen? Good luck buying a barrel at that price. The real price between $120 and $160 a barrel." Consider the physical reality of oil. Inventories in parts of Asia and Europe have been drawn down during the disruption, leaving little buffer against renewed shocks. Supply chains cannot snap back instantly. Even if Hormuz were fully operational tomorrow, it would take 40 to 50 days for flows to normalize and for stockpiles to be slowly rebuilt. During this period, actual transacted prices will remain high, reflecting the reality of the supply shortfall. Foreign investors appear to have grasped this reality more readily than their domestic counterparts and selling. In India, foreign institutional investors have been persistent sellers through April, offloading tens of thousands of crores even as indices climb. Of course, they have also been selling because of a fall in rupee, which erodes the returns in dollar terms. The divergence between markets and reality is not unprecedented. Financial markets often move ahead of events, discounting outcomes before they materialize. At times, this forward looking prescience is justified. At others, it is merely premature. What would it take for markets to be proven right this time? I am working with the assumption that Iran has the upper hand now, and hence I would keep an eye on whether Iran's core demands are being met, which center around uranium enrichment, tolls on Hormuz sanctions, and Lebanon. It's hard to see having imposed a chokehold with Russia and China's help why Iran would give away its leverage. The other possibility is the US not agreeing to any of these and launching a fresh round of war, probably a ground war, in which case all bets will be off once again. We will have to wait and see. If you like this video, please do share and please do subscribe to the channel if you haven't. Thanks for watching.